My name is Jake, welcome to the channel. I've been using M1 Finance for over 2 years now. My goal of creating this M1 Finance portfolio was to generate passive income or cash flow. 2 years ago, I transferred my Robinhood portfolio into M1 Finance. And there's been a lot of things that I've learned along the way when focusing on generating passive income. 2 years ago, I was in a good job. I was paid very well. It was very stressful, as kind of today. And I quickly realized that I didn't want to work until I was 60 years old. I realized that if I want to retire earlier or, reach financial independence, I had to do something different than what everybody else was doing. What I noticed was that everyone around me was just kind of, in the norm of, okay, I'm going to spend more money than I have. I'm going to buy everything on credit, and that's okay because it's normal. About 2 years ago, I asked my wife when she was happiest. And we were talking about, okay, what makes us happy? We're happy when we're together. We're happy when we're healthy. And what we found was that not once did we ever talk about our jobs in terms of when we were happy. Now, I know there's a lot of people out there that get a lot of fulfillment from their 9-to-5 job, from working. My wife and I, we're different. We don't find, fulfillment from our jobs, and that's not something that really brings us happiness. And so when we were thinking about, okay, we need to do something a little bit different from the norm if we want to live a different lifestyle than the norm. And so we started investing really heavily in a dividend growth strategy and trying to really build a dividend growth portfolio. In this video, I want to share with you some of the things that I've learned, some of the mistakes that I've made, so that hopefully you don't have to make the same mistakes that we made. Before I was using M1 Finance, I was kind of all over the place. I would invest into penny stocks, I'd invest into pharmaceuticals, hoping that they would 10x in a month. And in some cases they did, in some cases they didn't at all. And I was kind of, back and forth. It was an emotional roller coaster, and I understood that this wasn't really something that I could do long term. It kind of felt a little like this.
Молодец, Света, умничка, умничка. Все, операция удалась.
Oh my gosh, I love that. All right, so the very first thing that I want to talk about, when looking back over the last couple of years, what's really helped us has been to automate our investing. Before we were using M1 Finance, I would just at random, whenever I had the money left over, I would then transfer to my brokerage, and then I would invest in a strategic way, just kind of sporadically. All right, I'm going to put a little money there, a little bit of money there. It was not calculated, it wasn't planned, and therefore it really wasn't something that was growing over time, and I noticed that. And so with M1 Finance, it's very different than other brokerages because it's focused on the overall portfolio. Whereas, for example, with Robinhood or other brokerages, it's more focused on individual investments. So if you do an automatic transfer, it's transferring directly into that investment that you have it set up as. Now with M1 Finance, it's focused on the portfolio, and this is all based off of the portfolio weighting and the target allocation. So you can see that some of the slices here are overweight, whereas other slices are underweight. And when you have the auto invest set on with M1 Finance, it will automatically invest into your underweight holdings. So for example, here in the consumers, staples slice here, it's the exact same concept where each individual slice has a target weighting and an actual weighting, and then M1 Finance will automatically invest into your underweight holdings, which causes a automatic rebalance without causing a taxable event. So really, really important there. And then also very important that you're transferring over on a regular basis, whether it be weekly, bi-weekly, bi-monthly, monthly, whatever it may be, as long as you're doing it on a regular basis, that's the most important thing. And that's really what my wife and I learned while using, M1 Finance and investing. It's been about consistency and automating our investments. So that's the first takeaway. If you're new to investing, the sooner you can automate your investing, the sooner you're going to see those compounding returns that you're looking for. The next thing that I want to talk about is buy what you know. Okay. When I first set up my portfolio 2 years ago, I had so many different companies in here. If you go back and you look at my older videos, I had roughly 100 companies in my portfolio. They were all really, really great companies, but I really was going wide. I wasn't focusing on my core strategy and my core holdings. And that's something that I've learned about myself. And that's what I would encourage everyone that is watching this video, that when you're building out your portfolio, M1 makes it so easy, so seamless to invest and, and to go wide and to have a ton of companies. But I don't think it's always the right approach for everyone. Now, that's just my personal opinion. I don't think there's a one size fits all when it comes to that. But I learned for myself, especially here with the pandemic last year, I learned that, when I was seeing these companies that I was investing in go down 30%, 40%, it really got me to think, okay, well, it can't go any lower. This is the lowest it'll go. And then the next week it went down another 10%, right? And then I started to notice in myself that I was getting very emotional. And we all know that emotions in investing is not a good thing. It's not a good thing to be emotional when you're investing. Ideally you want to be, pragmatic about your investing, but investing is an emotional activity. And so I learned something about myself, that I was investing into businesses that I didn't really understand. And that's a mistake that I'm very, very willing and open to admit to, that back during the pandemic last March, I sold out of a handful of companies because I didn't really fully understand them. I didn't feel confident in my ability to hold on to these businesses because I didn't know how they all generated their revenue. When it comes to investing, it's always easy to invest when there's a bull market. It's always easy when you see the price go up, but when you see the price go down, it's very difficult. And this is some words of wisdom to all you new investors out there. If you've never experienced a bear market, it's easier said than done. When you say, yeah, okay, I'll just hold when the market goes down. It's easy to say that when all you know is up and to the right, all you know is green, green, green. It's difficult when you see your investments plunge 30 or 40% and to still hold on if you don't have conviction in your holdings and the companies that you're invested in. And it really teaches you as an investor what your risk tolerance really is. And during the crisis here last year, I adjusted my portfolio dramatically because I learned something new about myself. When talking about this, I think Peter Lynch explains it very well when it comes to your regular investor, what they should focus on when they're looking to invest into the stock market.
I'm amazed that the average investor is out there in some industry. They're in the polyvinyl chloride industry, they're in insurance, they're in textiles, and they're going to see those industries turn. And they're not going to buy those stocks. They're going to go buy some stock from somebody in the National Guard, or they're going to something on television in biogenetics. They have a big edge in me. I work awful hard, and they're months ahead of me. They can be in the healthcare industry. They're seeing new products. They should work on that they have in front of them.
As they used to tell writers, write what you know, you're telling them buy what you know.
Yes.
So the key takeaway here for me is invest in what you know. And if you ever find yourself asking the question, well, is this a good stock? Is this a good investment? Ask the question, do you know how they generate income? And you'll have your answer right there. One of the mistakes that I made when I was first investing into this strategy was thinking that I had all the answers. I thought because a company had a great track record, because they were going up into the right, they were always increasing their dividend, that it was a foolproof plan to generating passive income. I quickly learned that this wasn't really the case. You have to understand that you don't have all the answers. Just because a company has a great track record, at the end of the day, you're investing into a business. So you have to understand as an investor that you have to be flexible and adaptable. And with the pandemic here last year, I think that really exposed a lot of the inefficiencies and the gaps in the market where some companies really were caught with their pants down, to say it lightly, where a lot of companies were forced to cut their dividend. In some cases, this was vertical specific, right? In the hospitality sector, or with restaurants, hotels, that's a little bit different. But in other industries where they were forced to cut costs, trim their employee headcount, those kind of things, as an investor, you have to understand that there's no foolproof path to generating passive income. Every investment comes with some level of risk. And if you understand that, you can be flexible and you can be adaptable as an investor. As I mentioned last year during the pandemic, I learned something as an investor. I learned that my risk tolerance really wasn't as high as I originally thought. A lot of new investors, if you've never been through a bear market where you're seeing your portfolio drop every single week, it's frustrating. Your emotions are high. And what I learned was I want to focus on my core strategy and I don't want to, listen to all the market noise. There's a lot of things that are going on. I follow the core and satellite, methodology when it comes to investing. I have my core holdings. My core holdings would be, my PepsiCo, my Coca-Cola, my Procter & Gamble, my Kimberly-Clark, and my high growth, dividend growth ETFs. Those are my core holdings. Those are the core holdings that I'm focusing on and relying on to generate passive income every year. Every month, there seems to be something new. There's a new hype, a new trend. I remember as a kid, looking at all these trends, you got the yo-yo. I was really good at playing with the yo-yo when I was a kid. I had Pong cards. I had, Pokemon cards. I had, I was really into skateboarding when I was a kid. Like every year there's something new. There's a new fad. There's a new trend. And what I've learned these last 2 years is focus on your core. Focus on what really is your core strategy, and all the noise outside, try to, understand that it's real. You can, take part in it. That's why we have the satellite holdings, the positions, but for the most part, you want to focus on your core strategy and avoid the market noise. And lastly, you want to track your dividend progress. This graph here shows the monthly dividend income from our M1 Finance portfolio here, the cash flow portfolio. As you can see, the first year was a bit choppy. It was not consistent. There was a lot of mistakes that we made, not automating our investing, changing our portfolio, changing our strategy. And it wasn't until about the pandemic where we really started being more consistent, investing more intentionally, and really focusing on our core strategy. I share this with you because it's important to be transparent. A lot of YouTubers only show their successes. They don't show their mistakes. And I want to be very transparent that I don't have all the answers, but it's been a process and I am so excited to see the portfolio continue to grow. And I am so excited to share this with all of you. I hope that this video was helpful. I hope that if you're new to investing and you see this chart, that the first year, it was a little bit discouraging, right? It took an entire year to get to $200 in monthly cash flow with this portfolio. Now the portfolio is snowballing and growing, and I am so excited to see the portfolio continue to grow. Thank you so much for watching, everybody, and I'll catch you in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.